stop what you're doing. Seriously, if you hold any insurance stocks right now, or if you're just a retail investor totally terrified by the current market softening, you need to hear this. The property catastrophe sector, it is facing an absolute bloodbath. We're talking double-digit rate decreases, and honestly, most companies are just bleeding out. But I dug deep into Arch Capital's Q1 2026 earnings to see how they're handling the cycle, and what I found absolutely shocked me. Because instead of drowning, they are literally building an empire. Let's start with a number that should make any value investor stop dead in their tracks. Arch Capital just quietly reported a staggering $901 million in after-tax operating income. Yep, $901 million. That translates to a massive $2.50 per share in just a single quarter. To put that into perspective, while their competitors are actively losing money chasing terrible, underpriced premiums, Arch's profit engine is just firing on all cylinders. And that crazy bottom line profitability, it drove an absolutely wild 17.8% annualized net income return on average common equity. That is nearly 28% above the industry median. So is this a Warren Buffett-style buy-and-hold masterpiece, or just a value trap hiding behind one lucky quarter? Well, by the end of this explainer, you'll know exactly whether Arch is delivering a masterclass in capital allocation, or if those impending market headwinds are going to tear them down. And here's the kicker. They aren't just hoarding this cash. They rewarded their shareholders directly by executing $783 million in share repurchases in Q1 alone. So the real question we gotta ask is, how on earth are they pulling this off in such a toxic environment? And what's their next strategic move? Today, I'm going to give you a clear, actionable framework you can use to understand exactly how elite management teams allocate capital during a major market downturn. So, here's our game plan. We are going to quickly cover the Q1 earnings blockbuster, then look at how they're facing those brutal market headwinds, explore their protective shield in insurance and mortgage, dive into that massive $3 billion buyback, and finish up with their AI integration and market outlook. All right, Section 1, the Q1 earnings blockbuster. Let's dive into exactly where that $901 million profit engine actually lives. Arch's wildly diversified platform is the secret sauce here. Reinsurance obviously contributed the lion's share, bringing in $441 million. But look at those vital support systems. Mortgage brought in $221 million, and insurance added another $66 million. This isn't just one lucky bet paying off, right? It's a perfectly balanced three-legged stool that keeps their earnings incredibly stable, even when one sector starts looking a little shaky. Moving on to Section 2, facing market headwinds. Look, these massive numbers did not just happen in a vacuum. The property catastrophe market right now is a harsh reality. We're talking double-digit rate decreases and insanely severe competitive pressures. It's a really tough environment where a lot of companies are losing their shirts chasing bad premiums. But Arch, their response was a selective withdrawal. They literally chose to walk away from inadequate pricing to prioritize profitability over volume. Honestly, think of Arch like a highly disciplined poker player. They simply fold bad hands instead of bluffing and losing all their chips. And this exact approach is what CEO Nicholas Allen Papadopoulou calls disciplined cycle management. What that really means is they dynamically add to areas where returns are super attractive, like specialty casualty and excess and surplus lines, while flat-out declining risks that don't give them an adequate margin of safety anymore. They are totally fine with shrinking their top-line growth if it means strictly preserving the bottom line. You know, that is an incredibly rare trait in the corporate world these days. Which brings us to Section 3, the shield, focusing on insurance and mortgage. This discipline extends directly into their other segments, which act as this vital shield when reinsurance gets choppy. Just look at the insurance segment. Severe competitive pressures kept top-line growth essentially completely flat. Gross premiums written were up slightly by 2%, but check this out. Net premiums written actually dropped 1.4%. Why? Because again, they walked away from business that just didn't pay them enough for the risk. That slight drop is not a failure at all. It's a super calculated protective maneuver to make absolutely sure they only take on profitable risk. Meanwhile, the mortgage segment is acting like a massive anchor of stability. They pulled in $266 million in net premiums earned. And even more impressive, their credit quality remains top-notch. The delinquency rate actually dropped to 2.06%. I mean, while affordability challenges and sky-high rates are putting a stranglehold on the wider housing market, Arch's mortgage segment is out here totally exceeding expectations and providing a highly diversifying source of earnings. All right, let's hit Section 4, the $3 billion buyback. So, this brings us to the most crucial point of the whole explainer. Let me ask you a rhetorical question that can literally make or break an investment thesis. What happens when organic growth slows down, but a company is still generating massive amounts of cash? For a lot of management teams, this is the exact moment they panic and make terrible, overpriced acquisitions. But when attractive organic opportunities shrink and Arch doesn't want to underwrite bad risks, what do? They turn to the ultimate reward mechanism. They turn that money hose directly back on for the investors. In Q1, their capital allocation strategy was aggressive. They bought back 8.3 million shares for $783 million. That one aggressive move helped pump up their book value per share by 1.7% in a single quarter. But they're not stopping there. The board just authorized a fresh, massive $3 billion repurchase program. I love this quote from CFO François Morin. He put it perfectly. If we can't grow, we can't deploy the capital in the business. We'll be returning more of the capital to the shareholders. It's that simple. When capital cannot be deployed for outsized growth, they absolutely refuse to hoard it imprudently. They just return it to keep that return on equity looking incredibly attractive. Seriously, it's capital allocation at its absolute finest. Finally, we have Section 5, AI and Market Outlook. Arch isn't just playing defense right now, they are actively building for the future. They've recently finished up this massive AI-driven system migration, integrating their middle market commercial business from Alliance in just 18 months. They're using AI to accelerate testing and code workflows. And listen, this isn't just corporate buzzword bingo. This is a highly tangible operational upgrade that sets them up for massive scale and efficiency going into 2027 and beyond. And as CEO Nicholas Elaine Papadopoulou points out, Arch's 25-year record of strong returns and compounding book value at double-digit rates is a direct result of hard work and discipline. Think about that for a second. A 25-year track record of double-digit compounding puts them in legendary territory. It just goes to show that their entire corporate DNA is fundamentally built on discipline. Which naturally leads us to a pretty vital question for you watching right now. Despite the softening reinsurance market, is Arch's insanely disciplined capital return strategy still undervalued by the broader market? Have investors fully priced in a company that is actively willing to shrink its own premiums just to grow its per-share value? Well, according to Simply Wall Street's quantitative analysis, Arch's strong capital return narrative and robust earnings support a fair value estimate of $109.84. Based on its recent trading price, you're looking at a potential 15% upside. And honestly, community estimates often range even higher, which just shows that when a company effectively buys back its own stock while maintaining a fortress balance sheet, intrinsic value can climb super fast. So, I want to leave you with this final provocative thought. Armed with a totally fortress balance sheet, a highly disciplined management team that flat out refuses to chase bad risks, and a massive $3 billion buyback authorization just sitting in their war chest, what exactly will Arch's next move on the chessboard be? Are they just going to vacuum up their own shares, or are they waiting patiently for the market cycle to turn so they can strike at the perfect moment? Let me know what you think. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you on the next one.